What if I told you there's a simple strategy that could protect your wealth, reduce your taxes, and give you more financial control? If you're a business owner in Canada, setting up a holding company might be one of the smartest financial moves you ever make. Today, I'm breaking down the top 3 reasons why you should seriously consider a holding company and how it can give you a major financial advantage. Hi, if you're new here, my name is David Drummond, founding partner at DLD Financial Group and a certified financial planner, CFP. And I help Canadians like you navigate retirement, tax strategies, and financial planning. And I help Canadian business owners build smarter financial strategies to grow and protect their wealth. Let's dive in. Reason number 1, protect your business profits from risk. If you run an active business, an operating company, your company's assets, including cash, investments, real estate, and even intellectual property, are legally tied to that business. This means that if something goes wrong, such as a lawsuit, creditor claims, or even unexpected financial troubles, everything your company owns could be at risk. A holding company, or HoldCo, acts as a protective shield by separating valuable assets from the daily operations of your business. Here's how it works and why it's so crucial for business owners in Canada. How a holding company protects your wealth when you own a business. Profits accumulate within the operating company, OpCo. If that money stays in the OpCo, it remains exposed to potential risks, including lawsuits. If your company is sued, creditors or legal judgments could come after business assets, bankruptcy or insolvency. If your business faces financial trouble, excess cash and investments could be lost in debt settlements. Unexpected industry changes. Some industries are more volatile than others. Regulatory changes, economic downturns, or disruptions could put your business at financial risk. By transferring excess profits to a holding company, you effectively move those assets out of reach of those risks. Here's how it works. Your OpCo transfers surplus profits to your HoldCo through tax-free intercorporate dividends, as long as both companies are Canadian-controlled private corporations or CCPCs. Once in the HoldCo, that money is no longer tied to your OpCo's liabilities, shielding it from potential legal or financial claims. The HoldCo can then hold these funds as cash reserves, investments, or even real estate without exposing them to business risks. Real-world example, why this matters. Let's say you own a successful construction company. Over the past few years, business has been strong and you've accumulated $500,000 in return earnings in your OpCo. Now imagine one of your employees is involved in an on-site accident and a lawsuit is filed against your business. The court finds your company liable for damage, and if that $500,000 is still in your OpCo, it could be used to settle legal claims or seized by creditors. But if you had previously moved that money to a HoldCo, it would be untouchable because it is legally separate from your operating business. That's the power of asset protection through a holding company. What if you own multiple businesses? If you operate more than one business, a HoldCo provides even more protection. Without one, if one business, say business A, faces legal trouble, creditors could potentially go after all of its assets, including profits, real estate, or investments. However, if your assets are structured properly, business A and business B are both subsidiaries of the HoldCo. Profits are then moved to the HoldCo through tax-free dividends. Business A gets sued, only its own assets are at risk. Business B's profits stored in the safety of the HoldCo remain protected. This is especially useful for business owners who operate a high liability business, say construction, healthcare, or consulting, own multiple locations or franchises, plan to sell one business while keeping another. What happens if you don't have a HoldCo? Without a holding company, you're exposing all of your business wealth to risks that could wipe out years or even decades of hard work. If your OpCo faces a lawsuit, all company assets could be used to settle claims. If your business goes bankrupt, your return earnings, cash reserves, and investments could be lost. If you plan to sell your business, excess cash in the OpCo could disqualify you from key tax exemptions, like the lifetime capital gains exemption. A holding company provides a simple way to protect and preserve the wealth your business generates, ensuring that your assets are safe no matter what happens in your operating company. Reason number 2, tax deferral and flexibility. One of the biggest benefits of setting up a holding company is the ability to defer taxes and control how and when you withdraw income. Without a HoldCo, business owners often face higher personal tax bills than necessary, simply because they don't have the right structure in place. A HoldCo allows you to hold on to your business profits in a tax-efficient way, letting your money grow until you actually need it, rather than paying unnecessary taxes today. Here's how it works and why it can save business owners tens or even hundreds of thousands of dollars over time. How a holding company defers taxes and lowers your tax bill in Canada. Corporate tax rates are significantly lower than personal tax rates, especially for small business owners who qualify for the Small Business Deduction, or SBD. Let's break it down. If your business is a Canadian-controlled private corporation, or CCPC, it pays a much lower tax rate, probably anywhere from 9 to 12%, depending on the province and the first $500,000 of active business income. If you pay yourself a salary or dividends right away, that income is taxed at your personal rate, which could be as high as 50% or more in some provinces. By moving excess profits to a HoldCo instead, you avoid triggering immediate personal taxes and let that money grow tax deferred inside the company. Example, how a HoldCo saves you on taxes. Let's say you own a successful consulting firm and your business earns $400,000 per year. Without a holding company, you pay yourself $200,000 as salary or dividends. That $200,000 gets taxed at personal tax rates, let's say 45%. After taxes, you only keep $110,000. With a holding company, your OpCo only pays you what you need for living expenses, let's say $80,000. The remaining $120,000 in profits is transferred to the HoldCo as a tax-free intercorporate dividend. That money stays in the HoldCo, growing tax efficiently until you actually need it. The result? You avoid immediate high personal tax rates. Your money continues to grow inside the corporation instead of being eroded by taxes. You withdraw it strategically in lower tax years to reduce your overall tax burden. By using a HoldCo, you control how and when you pay yourself, ensuring you keep more money in your pocket over time. How a HoldCo helps with income smoothing and tax bracket management. A HoldCo doesn't just defer taxes, it also gives you control over your tax bracket. This is especially useful for business owners who experience fluctuating income from year to year or plan to retire early. As an example, how a HoldCo helps with tax planning and retirement. Let's say you're a business owner in your early 50s and you plan to retire at 60. Now, without a HoldCo, if you draw large dividends during high income years, you pay tax at the highest marginal rate. If you stop working at 60, you may have little or no income, but you've already overpaid taxes in prior years. Now, with a HoldCo, you save excess profits inside the HoldCo during your working years. Once you retire, you withdraw money strategically in lower tax years, keeping yourself in a lower tax bracket. This lets you minimize taxes paid over your lifetime instead of being forced to take large taxable withdrawals when you're earning the most. The ability to spread out your income over time is one of the most powerful tax planning tools available to business owners. Income splitting. Reduce family tax burden is another huge tax benefit of a HoldCo. The HoldCo has the ability to income split with family members, as long as it's done properly and within Canada's tax. If your spouse or adult children are in lower tax brackets, you may be able to pay them dividends from the HoldCo at a lower tax rate, reduce the overall family tax burden, move money out of your hands and into theirs in a tax efficient way, and the risks of not having a HoldCo or losing the tax deferral advantage. If you don't use a holding company, all the profits you generate inside your OpCo must either be reinvested in the business or withdrawn. And if withdrawn, it's fully taxed at personal rates. If you take large dividends today, you pay high personal tax rates immediately. If you leave the money in your OpCo, it may cause problems with your tax exempt status if you plan to sell your business later. We'll cover this in reason number 3. Many business owners overpay taxes for years simply because they don't use a HoldCo to structure their income properly. Reason number 3, smoother business sale and succession planning. If you plan to sell your business one day, a HoldCo can help you structure the sale in a way that minimizes taxes and maximizes your after-tax profits. For example, the lifetime capital gains exemption allows you to sell shares of a qualified small business and avoid capital gains tax on up to $1 million in gains. That's the 224 limit. But here's the catch. If the OpCo holds too much passive cash or investments, you could lose this exemption. By regularly transferring excess cash and non-business assets to a HoldCo, you purify your OpCo, keeping it eligible for the lifetime capital gains exemption. As an example, a business owner sells their company for $2 million. Because they structured the sale properly with a HoldCo, they qualify for the lifetime capital gains exemption and save over $250,000 in capital gains taxes. Without this planning, they would have paid tax on the full amount. A HoldCo also makes succession planning smoother if you want to pass the business down to your children. Instead of them inheriting a risky OpCo, they can receive shares of a well-structured HoldCo with tax-efficient estate planning benefits. To recap, here are the top 3 reasons you need a holding company. 1. Protect your business from risks by separating assets from your operating company. 2. Defer taxes and gain income flexibility by controlling when and how you withdraw funds. Number 3. Optimize a business sale or succession plan by structuring assets to maximize tax advantages. If you're a business owner and want to know if a holding company is the right move for you, book a free consultation with me and my team today, and we'll help you create a tax-efficient strategy that protects your wealth and sets you up for long-term success. Click the link in the description to schedule your call. Thanks for watching. See you in the next video. All the best.